Did you know that millions of people are paying hundreds, sometimes thousands of dollars more in interest every single year? Not because banks are evil, but because an algorithm decided you're worth the price. Welcome to the quiet trap of the credit card interest rate, where your financial fate is handed to a machine, and that machine has already made up its mind about you. We're talking about a system where the average credit card APR has climbed past 22% in recent years, a number so absurd it would have made economists in 1995 choke on their coffee. Cannon's story is the one that puts a face on this invisible wall. She called her bank, asked for a lower rate like every personal finance guru told her to, and got rejected faster than a bad Tinder profile. The bank didn't just say no. They said, your rate is perfectly calibrated to someone exactly like you. Which sounds polite until you realize they're essentially telling you that your past is your permanent address. It's not personal, it's actuarial, and that's almost worse. Because there's no villain to argue with, just a model running quietly in a server room somewhere in Delaware. Here's the mechanism that most people never see. When you call and ask for a rate reduction, the bank doesn't have a human leaning back and thinking it over. They're running your credit profile through an automated underwriting system that scores you against a pool of similarly situated borrowers. If your score, utilization, payment history, and debt load look like people who statistically default more often, the system flags your current rate as already appropriate. And the answer is no before the conversation even really starts. Think of it like trying to negotiate your car insurance premium by calling customer service. If the actuarial table says you're a 26-year-old male in Houston with 2 speeding tickets, no amount of charm changes the math. The bank is essentially saying, we've already priced you correctly. And the cruelest part is they're often technically right, given how risk models are built. What's optimized for the institution is rarely what feels fair to the individual sitting across from that phone call. Earlier in the low-rate era, think 2019, 2020, there was this collective optimism that consumers had leverage, that competition among issuers would force generosity, that a well-timed call could shave 5, 6, 7 points off your APR. That hopeful era has quietly evaporated into an environment where rates are elevated, credit stress is rising, and banks are tightening, not loosening. They're automated guardrails around who qualifies for relief. The psychological toll of this is underrated. There's something uniquely demoralizing about being told by a faceless system that your circumstances are expected, that your risk is already factored in, that you are, financially speaking, exactly average in the worst possible way. Financial therapists will tell you that this kind of institutional rejection can actually reinforce avoidance behaviors, where people stop engaging with their debt at all because engaging feels futile. And futility, as any behavioral economist will note, is how manageable debt becomes catastrophic debt. Here's the historical irony though. Credit card interest rate negotiation has always been a numbers game, where the odds favor the already advantaged, and we've known this for decades. Studies going back to the early 2000s showed that consumers with higher scores who called and asked received reductions at significantly higher rates than those with average or below average profiles the system rewards, those who need the help least. Every cycle of rising rates exposes this asymmetry again, and every cycle we're surprised by it, which is its own kind of dark comedy. Let's bust the biggest misconception right now. Calling your credit card company and asking for a lower rate is not a negotiation in the traditional sense. It's an inquiry into whether the algorithm will permit a deviation from its model. If your credit profile hasn't materially changed, no amount of loyalty, politeness, or persistence will override a risk model that's been tuned to minimize bank losses across millions of accounts. The actual lever isn't the phone call, it's the credit profile itself. So what do you actually do with this information, practically speaking? You focus relentlessly on the variables the model measures. You bring utilization below 30%. You make every payment on time with almost religious consistency. And you let time work on the age of your accounts. Because those 3 factors together are the inputs that literally move the risk score that the automated system uses to make its decision. Rate reduction requests succeed most reliably 6 to 12 months after a meaningful, measurable improvement in credit profile, not before. The broader lesson here is about playing a long, process-driven game rather than swinging for a single phone call victory. Small, consistent actions, paying more than minimums, not opening unnecessary accounts, keeping old cards active compound quietly in the background while you live your life, and then one day the model sees a different you. Conviction about a single tactic is far less valuable than disciplined consistency across a boring, unglamorous strategy. Philosophically, this is really about accepting that systems have rules. And the most powerful move is learning the rules of the system well enough to maneuver within them rather than rage against them. Sizing your expectations correctly, knowing that a cold call rarely wins, but a rebuilt profile almost always does, keeps you from emotional decisions that cost you more than the high rate ever would. The most dangerous thing in personal finance isn't the 22% APR. It's the reactive, frustrated decision-making that APR provokes. And here's where we land. Discipline, positioning, and patience are not just investment virtues. They are credit virtues, debt management virtues, financial survival virtues. You can be comfortable with where you are right now, as long as you're preparing rationally, building deliberately, and not letting a machine's assessment of your past define your future trajectory. The system is not personal, but your response to it absolutely can be. Whether you're trying to escape high-interest debt, build wealth through real estate, or just get your financial foundation right, the path forward starts with knowing which levers actually move. Check out our links in the description below, whether you're looking to get started in real estate investing, need home contracting work, or want to connect with trusted lenders. We can help you take that next step.